Good morning, ladies and gentlemen. Welcome to IGE Kita Breakfast Seminar. As we all know, the world economy is seemingly plummeting endlessly into the abyss. Is there a bottom or not? We don't know yet. But we are so much eager to know how deep it is and when it will hit the bottom. Then it is our best luck to have a chance, very valuable chance to hear from Dr. Sinai this morning, in person, not through teleconferencing or not only document, but in person, his views about the prospect and the perspective of the world economy. He comes to Korea every year, around this time of year. We missed him, am I right? And we were waiting for him to come. And he didn't disappoint us by coming to us this morning. Let me briefly introduce Dr. Sinai. I learned that he has earned his doctorate in economics in 1969. So I graduated college in 1970, so maybe we are similar age. So I feel more friendly with him by knowing that. He got a degree from Northwestern University, and then he started his career. His career as an economic forecaster, educator, the global strategist, advisor, consultant, very colorful career as a professional economist. In 1971, by joining DRI, Data Resource Incorporated. Do you remember this name still? Those of us who are as old as I am are more familiar with DRI or WIPA. At that time, the DRI and the WIPA were the two twin pillars of economic forecasting institutions. Now maybe the younger generations in this room are more familiar with global insight, but we are more familiar with DRI or WIPA. So he stayed there for 13 years until 1983, and then he was promoted to chief financial economist and senior vice president of DRI. And while he stayed there, he developed DRI model of the US economy, jointly with Dr. Otto Epstein. Epstein was the founder of DRI. And then he moved to Lehman Brothers in 1983. He stayed there for 14 years until 1996. He took the responsibility of chief global economist and the managing director. And one time during that period, he was executive vice president and the chief economist at the Boston company, which is asset management and banking subsidiary of Lehman. By half jokingly, let me say that if Lehman kept him, persuaded him not to leave, I guess Lehman would not encounter that disastrous misfortune. He also developed the Sinai Boston large-scale quarterly econometric model of the US. This is one of the largest and the most reliable macroeconometric forecasting model of the US economy. And In 1996, he left Lehman and he founded the Decision Economics Incorporated. He became entrepreneur by establishing this company. Let me call him the knowledge entrepreneur. Now he's chief global economist and president of that company. That company is serving over 300 financial institutions, corporations, governments, and individuals worldwide. And the clients include traders, portfolio managers, asset managers, CFOs, CIOs, etc. And quite interestingly, I learned that in Korea, there is no single member client yet of that company. You should promote your marketing more, I guess.
Yes, it's a business problem.
So I hope that we all hope that in the midst of this very gloomy and dark situation, he will deliver some of the more the brighter or hopeful or some of the gospels to us this morning. Thank you very much. Let's welcome him.
Thank you very much. It's nice to see you all, many of you again, here at the beginning of another year, 2009. I've been coming for many years. It's always been a great pleasure for me to come and speak to a cross-section of decision makers here in South Korea, in bad times and in good times, and now, let's face it, bad times. But we get through the bad times. We will get through this episode, which is and will be the worst global economic downturn since the 1930s. In the 1930s, we did not have 47 countries, which is now the span of our analysis, that account for over 90% of global output. Many fewer countries, but a worldwide recession, depression in the 1930s, with a number of characteristics in the 1930s that are disturbing because so many of them exist now in the world economy, including the run-up to the 1930s, at least in the United States, what in our country was called retrospectively the Gilded Age. The 1990s, part of it, for the United States, even during the Asian crisis, and the first 5 or 6 years of this decade, particularly lately, up until a year and a half or so ago, a kind of Gilded Age in the United States. By Gilded Age, I mean a period of time when huge excesses and imbalances were established and came into place. The similarities between the current situation in the 1930s bother me a lot as an analyst, forecaster, and historian, because history tends to repeat itself, especially for those who do not remember it. Currently, we are looking at a U.S. and global economy, 47 countries, including the U.S., that are in at least a long and deep recession. I might call it long and severe. Severe in the U.S. case, technically meaning, when I use that word, from peak to trough, the biggest decline since World War II. I think we are in a long and severe downturn in the U.S. The global economy, long and deep, but at the current time, as we look across the world, track the data, and do our forecasts, watching plummeting data in Japan. Japanese real GDP that in 2009 could be down 3 to 5%. An unusual decline in South Korean real GDP could be down 2 to 3%. Really a recession in China, 5 or 6% growth compared to 11% before. A positive number, but it's that change in the growth rate that creates all of the difficulties. 11% per year, booming year after year, everyone geared to the boom. When that 11% shifts down to 5 or 6% for whatever reason, the ripples that flow out, the dynamics of the shift in the growth rate to a lower growth rate hurt Asia in particular and the world in general. China is now the third largest country in terms of its economy, behind Japan and the US. Whatever happens, I believe China will be the second largest economy within a matter of 5 or 6 years. And we'll keep on chasing the United States. The seismic shift of the growing relative importance of Asia and the growing relative decline of the United States, North America, and Europe as a portion of total real GDP, that will not change by the deep cyclical downturn that we are in now. That indeed, for this part of the world, is a ray of sunshine. When the dust settles, as I talked about last year, longer run, Asia will be dominant and China will be dominant in Asia. That tendency continues despite all of the turmoil that we've had, and if anything, will probably be intensified by what we're going through now. But for the here and now, the length of the recession already in the United States, the length already in much of the rest of the world. It began last spring and early last summer for many countries, sooner than that for the United States. The depth, intensity of the downward sweep of economic activity, the collapse in trade flows, exports and import flows in Asia and around the world, and all of the problems that that creates for financial institutions, consumers, businesses in dealing with it is frightening. You know, I've been doing this, as you mentioned, for a long time. Glad to hear you've been around about almost as long as I have been. I'm like a doctor. I have seen over 35 years of professional work, a lot of sick patients at countries with cyclical illnesses, sometimes a cold. The U.S. has had colds. The rest of the world has gotten that cold. Asia had a cold, actually a flu, rather severe episode in the late 1990s. The U.S. didn't catch that. And here, the U.S. is very, very sick. And as I look at the symptoms and what I see, some of it is familiar. Some of it is not. Some of what isn't familiar looks like what I read about in the textbooks in the 1920s and 30s and as part of my studies. Like a doctor sees a patient with some similar symptoms, but an illness that isn't easy to define. I carry my medicine bag with me. I've been in and out. I've been in Washington, I think, 15 times in the last 2.5 months, talking to and advising Republicans and Democrats, people in the Obama administration, Federal Reserve. And I am uncomfortable with what I don't know. Too much of what I see, I cannot fully explain. I have not seen it in the complexity with which it presents itself. It's almost as if a new virus, the bird flu, is running around, and we don't know quite how to figure it out. We haven't been able to genetically mark it, That makes it very difficult to decide what medicine or policies to use. And then, of course, there are huge uncertainties around those medicines or policies that we do use in terms of what might happen. I think, to be candid with this audience, I should confess what I don't know, and that I am uncomfortable with that, and much more uncertain about the future than any other time since I have been doing this work. Most of the time it's garden variety recessions in one country or the other. Here we have a complex global phenomenon with the global economy as we measure it likely to be down in real GDP terms 0.5% to 1% in 2009, led by the most severe downturn in the United States since the 1930s, a very big downturn in the Eurozone, similarly so for the UK. What is very scary in terms of the Japanese situation, and the third largest country of the world in some sort of a recession, I would argue, at 6 or 7% growth or 5% growth, all happening together, complicated by a world financial system, particularly the US financial system, that in the sense of credit and intermediation has essentially collapsed. So it's fair to say that the global US economy and the global economy, I think, is in an economic crisis. And we also have, unfortunately, at the same time, a financial crisis. The two are interdependent. The financial crisis and financial factor, in my studies, is always part of the upper turning point of a business cycle. The upper turning point of a business cycle reflecting the booms and excesses of the expansion, which culminates in the boom along with the financial factor, in this case very complicated, bringing down the economy, the financial factor intensifying the downturn, and then the downturn intensifying the financial problems, an interactive, poisonous mix which ultimately reaches a bottom, typically with help from central banks, sometimes with help from fiscal policy, sometimes mistimed, more often mistimed than a help, and really essentially fixed and healed by the private sector itself. As the private sector makes the adjustments, takes down the imbalances and excesses that are part of the process of regeneration that leads to the next upturn. We are nowhere near the end of this, in our view, but at least we are probably halfway through. It is very difficult to mark an end to the U.S. and global downturn. And when we have a recovery, which we will, as sure as the sun rises each day, we will move from recession to recovery. But that recovery and the health of it is a big question mark at this time. For the U.S. downturn, we are marking real GDP growth this year, 2009, at down more than 2%. That would be the worst annual result for real GDP in post-World War II history. This is a figure that X's out, does not take account of the impacts of the economic recovery plan now underway in the United States. We think of it as a baseline more than a forecast because the economic recovery plan, $800 to $900 billion of fiscal stimulus spread over 2 years, 3 to 4% of real GDP each of 2 years, will certainly make a difference in the path of real GDP compared to if we did not do the recovery program. So there will come a time when I will not give you two tracks. It's a little early in the year. We don't know exactly how that program will work out. We have analyzed it. We've quantitatively estimated in our big model of the U.S. economy. But I want to first give you the picture without it. What is bringing the U.S. economy into such a negative configuration? And then say something about the U.S. policy responses, monetary and fiscal, and then give you what we think those policies might do for the U.S. economy, and then in turn the U.S. economy for the rest of the world over this year and next. Currently, the U.S. economy is being driven down by very weak aggregate consumption. The figures out this past Friday showed aggregate consumption, inflation adjusted, down about 3.5%. In the third quarter, aggregate consumption was down 3.8%. You cannot find 2 quarters back to back with negative real consumption any time since the 1930s. We did have in the second quarter of 1980 a quarter-on-quarter decline annualized of about 10%. That was when President Carter imposed credit controls and consumer spending shut down. But in almost every down cycle, consumer spending goes down, not always negative. It goes down relative to its normal behavior, and then after no more than 6 or 8 quarters, bounces up again in response to the policy stimulus and the natural exuberance of American consumers in terms of how they spend, how much they borrow, how much debt they take on, this almost historically insatiable thirst and demand for consumer goods and services. Of course, that has benefited much of the world. Currently, the U.S. consumption or consumer is about 70.5% of real GDP. 2 quarters ago, 71.5% of real GDP. 10 years ago, 2/3 of real GDP. Over the last 10 years, consumer spending has moved way up relative to what it had been in the past as a percent of real GDP as we borrowed, accumulated debt, took on credit, and ran a negative personal savings rate. We're going to have to go back to a more normal proportion of real GDP, and we are in the process of doing that. But the fundamentals around this big aggregate consumption, 2/3 of the U.S. economy, therefore a major source of demand for the exports of many exporting nations around the world, that big lump is a big deal. And as we track the fundamentals around consumer spending, for the first time in decades, if not the first time ever in my professional career, I cannot offer words of encouragement to any business, financial institution, or country that is in the game of selling or servicing American consumers. Just the opposite has been the theme for year after year, decade after decade, from me. Don't worry about the American consumer. We love to spend. We will find a way to spend heavily. We will beg, borrow, and steal. Only kidding about stealing. Well, we don't do that. We will beg, borrow, and steal, but we will make sure we satisfy our drug habit of heavy-duty consumption. I think just the opposite is happening now. I was so reluctant to strike this theme a year and a half or 2 years ago because it runs against the grain of the American psyche and the history. But I'm now old enough, so I don't mind making a forecast that's really a forecast because it's never happened before. That's really a forecast. If it hasn't happened before, it's really a forecast. What we are seeing, we have not seen. That is a trend shift, a seismic shift in the American consumer from, on average, an incredible pace of spending that lifted the world. Those who exported to the American consumer, which is almost everybody, that's gone. Gone for as far as we can see. Why? Well, the fundamentals of consumer spending, as we model and analyze it and track it, are all negative. On a secular basis and on a cyclical basis. Cyclically, we have an intense downturn in consumer spending in the aggregate. On a long-term basis, we don't think, even when we come out of this, we will be anywhere near the average rate of growth of history for American consumption, which has been, and I'm sure over the years, I have mentioned this number to you, up until 2 years ago, 3.5% a year inflation adjusted for 45 years. 3.5% a year inflation adjusted for 45 years for consumption is a higher rate of growth than the American economy in real GDP had over those 45 years. And so that's the history, that's the average. We've just had 2 quarters of -3.5 to -4. The fundamentals around the consumer, short and long term, say to us that when we come out of this, we will grow in consumption spending, but nowhere near 3.5% a year inflation adjusted. If you're a business, financial institution, if you're a country that is used to your end market, directly or indirectly, growing at 3.5% a year, and that pace of growth shifts to 1.5% a year or 2% a year, guess what? Your world has changed immensely. It's the change in the growth rate. The technical people here who understand business cycle dynamics and study it understand something called the Accelerator Effect, where growth is all about shifts in growth rates, not shifts in levels of activity. Simple principle, but fundamental for all decision makers to understand that when China's growth rate shifts from 11% a year to 6% a year or 7% a year, that has a much bigger impact than if its growth rate had been 6% a year and declined to 5% a year. The boom in China and all that went with it becomes, in growth terms, a recession. The shift in the pace of growth for all those decision makers and activities that have been geared to 11% a year, which is what happens. If you're in business, if you don't gear your plans to that 11% a year, you lose out. You have to do it. When that shifts, that growth rate sets out all kinds of negative effects all over. When aggregate U.S. consumption, $9 trillion in real terms, maybe a little more, shifts in growth from 3.5% a year on average to 1.5% a year. We're not even doing that now for the last 9 quarters. But we have this downturn of 3 to 4%. Imagine the ripples going out to U.S. business in terms of sales and profits, to U.S. financial institutions who service the American consumer, and to countries like South Korea, for whom so much and so many exports, not necessarily directly, but directly and indirectly, are tied to that end market. 20% of China's exports, of their total exports, have gone to the U.S. China is the only country, of all the countries we studied in what I reported on to you a year ago, whose exports as a percent of total GDP to the United States went up over the last 10 years. South Korea's percent of total exports to the United States went down, but South Korea economy is so open so dependent on exports, dependent on China, so that when the U.S. consumer weakened, Chinese exports to the United States weakened, South Korean exports to the United States weakened, South Korean exports to China weakened. And when you throw Japan into that mix, given the trade propensities of exports and imports between China, South Korea, and Japan, you can understand why the business climate in just this part of Asia has plummeted. The downturn in U.S. consumer spending, both on a longer-term and shorter-term basis, has fallen way behind what went on in history. And my message to you and to others is, it's excessively negative now, but even when we come out of it, on the fundamentals around the American consumer and the prospect longer run for the U.S. situation, and even allowing for the new economic plan that's coming out of Washington, it will not be the same as it was before this downturn. Now, I could be wrong, but if I don't, when I come to a country that is as export dependent as this country is, and everyone in this room, wave this flag in the air at you, might be 20, 30% chance of what I'm saying. It doesn't necessarily have to be that way. I would rather say this to you as a warning so you can integrate it into your thinking about business, finance. It's such a change with history. And be wrong and come back to you a year later and say to you, I was wrong, than to say nothing and let it be this way and not sensitize you to it. Fundamental. Now, what are those fundamentals around the American consumer? By the way, this is the heart of the U.S. downturn. Consumption goes down, business sales and profits go down, business then cuts back, capital spending goes down, people are fired, the unemployment rate goes up, consumer spending goes down, credit risk increases both for the consumer and for business. Financial institutions are afraid to make loans because of the cyclical effects. It has nothing to do with subprime anymore. It has to do with the economic cycle. They don't make loans, it gets worse, and then we have to have some of the things happen that are happening out of Washington, and I will get to that. One is jobs and income. Real disposable income up about 2% year over year. That's far below what it typically is. That's the number one generator of spending. Second, household wealth down $10 trillion compared with a year ago. By our calculations, we lose 6 cents on a dollar of that $10 trillion loss in wealth. That's real estate value, and that is stock market value. That's $600 billion of lost consumption in 2009 from this effect alone, the wealth effect. There are no capital gains realizations on homes or in the stock market for people to cash in and to spend, on our estimates, 25 cents on a dollar of, just the other way around. Americans cannot borrow and refinance on their homes anymore and get free, essentially free money out of that because home values are going down and more families' mortgages are underwater than excessive. So they can't tap the housing equity faucet anymore. There is a credit crunch. Financial institutions are reluctant to lend to consumers except the most worthy credits, and they don't need the money. Consumer psychology, measured by the surveys, are at deep recession lows. They've improved a little bit lately. We think that's an election effect. All spirits in America were uplifted by this extraordinary victory of an African American. But worse, as we measure it, the household financial position, the financial condition of households is the worst it has been since the early 80s, and perhaps the worst it has been since the 1930s. We'll see what our index does. All the fundamentals. Now, we are in the middle of jobs cuts. We think we're going to lose over 500,000 jobs the next report, which is next Friday. That's a negative for disposable income. Wages and income, compensation and income, are not rising as much the next inflation numbers will not be negative, and so we will have real income growing less. The decline in housing prices and in the stock market continues. That means net worth or wealth this year will go down. We will lose spending next year because of that. Americans with a rising unemployment rate, psychology may improve some, but they're going to be afraid to spend. The household financial position will take years to correct. And it isn't that we can fix our financial position by refinancing our home and getting $100,000 or $200,000 out of an increase in equity. We can't do that. Americans are going to have to save out of income. They're going to have to save out of income. Americans have not had to do that for decades. Credit cards, borrowing on homes, borrowing on the stock market. No more. I think Americans intuitively understand what I've just said. There's no easy money and easy funding anymore. They're going to have to work and get income and save out of that income to replenish their retirement accounts to generate more funds for spending. That takes a long time. And if the policy in Washington is not heavily oriented toward tax cuts for consumers, they won't be getting a lot of money out of Washington either, like they did in the early years, some Americans in the early years of the Bush administration. We just can't see anything that's going to change or alter those six fundamentals for some time. Hence the view that for the first time in decades, on a secular basis, the American consumer is going to save more. The savings rate will go up 5 or 6, maybe 8%. Spending on average will weaken, and all those businesses, financial institutions, and countries that depend on the American consumer better rethink what they're doing. The hope for the world, of course, is that consumers in other countries will pick up the slack. As a doctor, long-run doctor of the U.S. economy, in a way this is healthy. The spendthrift consumer now can't do it, and whether consumers like it or not, they're going to be forced to save. But while we go through that, there's a lot of pain and adjustments and a lot of casualties along the way on the business side. Well, for the rest of the outlook on the United States, what we also are seeing is a caving in capital spending. That's no surprise. When sales and profits and expected sales and profits weaken, driven by now a bust in housing, which is still declining, and 70% of the economy going down. Think of the sales and profits growth or lack thereof for company after company in the United States. And what do? They cut back on people. They cut back on production. They cut back on capital spending, particularly technology, the equipment, because that's easily cut back on. They don't do new business ventures. They try to save all the cash they can. They cut dividends and try to survive. And that is my view of the mode for American companies these days. And the data show a stunning decline in capital spending in the United States in the fourth quarter of almost 20% at an annual rate down. We were forecasting 14, 15%, which was probably the most negative forecast on CapEx out there, and it was worse. And so, besides the consumer going down, we have now a capital spending down cycle, which typically lasts about a year in the United States. We're right in the middle of that. For U.S. exports, given the effects of a weak consumer and capital spending downturns, that's a big deal for technology. Big deal for technology. When consumers and companies cut back, what happens to electronics? What happens to all of the companies, South Korean companies, that export into that area of technology? It's a very negative part of the economic outlook. And that in turn reverberates through the rest of the world. We are now also seeing something that's not unexpected, except in how soon we are seeing it, a decline in the rate of growth of U.S. exports, which was stunning in the fourth quarter, as well as imports, reflecting what we see all over the world with a global recession, trade flows diminishing, and all the businesses around trade in big exporters and small exporters, the U.S. is a small exporter, suffering. Virtually all of the U.S. private sector is in a vicious downturn at the current time. We are expecting real GDP in the first quarter to be down 5 to 5.5%, down 2% in the second quarter, real GDP around 1 in the second half, and next year, without an economic recovery program, we would have been saying 1 to 2%. Now let me turn to the responses of the doctors. First, the U.S. Federal Reserve, to try to clarify for you what our central bank is doing. The central bank in the United States, Federal Reserve, finally, after missing this for quite a while, has understood the viciousness of the downturn in the United States and the global ramifications of that. And so, as you know, the federal funds rate has been taken down to near zero, and the U.S. is now involved in a kind of quantitative easing. Japan used quantitative easing some years ago when it took its policy rate near zero, couldn't take it down anymore. Faced with deflation and rising real rates because of a zero bound on that policy rate, it went to using its balance sheet to provide funds to the system, mainly to the banks, but also to some corporations who, because of the Japanese economy, couldn't do any better. They were called zombie corporations, funding the banks, hoping that they would lend, and funding some of the private sector, and buying along the JGB, buying government securities in order to keep rates low to help revive the economy. That was the Japanese version of quantitative easing. The U.S. version, which I call the American-style quantitative easing, is similar, but it is also different. And described by Chairman Bernanke and Member Yellen, it's more of a credit easing than it is providing funds just to banks. I describe it a somewhat different way. That the U.S. Federal Reserve now, not because it wanted to, but because it feels there is no chance, in effect has become a bank in the private sector. Central banks are lenders of last resort to banks. That's what the Federal Reserve did first. That didn't help, didn't work. Things got worse. It then became a lender of last resort to the primary dealers, banks and non-banks, investment banking brokerage houses, but not all just those, some insurance companies. That didn't work. It worsened in the economy and financial markets worsened, and some of those companies, including Lehman Brothers, are no more. The credit and financial intermediation system in the United States is broken. You know that. It's also true to some extent here. True many areas of the world. Why? Why would a profit-maximizing financial institution lend into the kind of environment that I am talking about? The environment that has evolved. It's too risky. You make loans today in the United States to consumers or to business, or buy stuff in the capital markets that other people are selling to raise funds through debt issues, and a year from now, year and a half from now, it may turn sour. A bank, any financial institution, may have to write that down. It's just not subprime anymore. It's all of the economic cycle related bad loans and investments that financial institutions often make in history and live to regret it later on. And so the funding that comes in to the financial institutions from the Federal Reserve does not go out. There's still a lack of transparency in the financial system in the United States of what the balance sheets are really like. If I ran one of these institutions, I wouldn't lend to anybody. I'd put it all in cash, which is what investors around the world are doing right now. To be safe, I want to come back and live another day. Indeed, that's what banks are doing. They have a huge amount of excess reserves. They're putting it in treasuries, it's Tier 1 capital, to hold their capital ratios up, and lending is not going on. And so the Federal Reserve, because it is fearful that we will have a repeat of the 1930s, where many of us who have studied it believe it was the banking and credit system that gave us the Great Depression, plus mistakes in policy, monetary and fiscal policy. Many of us believe that, but credit was at the heart of it. It was not the money supply, as the late Professor Friedman used to talk about. It was credit in the collapse of the banking system. The Federal Reserve is doing everything it can to keep credit flowing as much as it can to cushion the downturn in the U.S. economy, and even that has not worked. So here's what the Federal Reserve is doing on American-style quantitative easing. It has established a facility by which funds go to purchase commercial paper, asset-backed commercial paper of corporations that are good credit risks. That has helped the commercial paper market and reduced commercial paper rates and allowed a number of firms to keep somewhat liquid and be able to finance their work through working capital by going in this direction. It is buying directly from the major mortgage providers, mortgage finance providers, the so-called government-sponsored enterprises, their debt directly, which lowers the cost of that debt and hopefully lowers mortgage rates. It has about a $500 billion expansion of its balance sheet programmed through an entity by itself, buying directly mortgage-backed securities, conforming loans that are put out by Fannie Mae and Freddie Mac, hoping to keep credit flowing in the housing markets, supporting the housing markets, which has had, as you know, a bust. And now in February, there will be an entity that will provide term financing to consumers and small businesses, lenders, financed by the Federal Reserve, who was given $20 billion of the Troubled Asset Relief Program money, the TARP money, as capital, levering that up 10 to 1, $200 billion of lending power directly into the private sector. And the other day, the Federal Reserve told us that if conditions suggest it will be necessary, it will directly buy U.S. Treasury securities. For sure, the Federal Reserve will have to buy U.S. Treasury securities because the deficits the United States are going to run will be so huge that the Treasury issues of the U.S. government will be a literal flood. I doubt that the world will absorb all those treasuries at the kind of returns that exist. Somebody will have to buy them. It'll be Americans, and it will be the Federal Reserve. That will be how U.S. saving is deployed. We are actually going to have to finance ourselves, is what I'm saying. I don't know where 10-year Treasury yields will go in that situation, and I am fearful about ultimately what might happen to the dollar, depending on how the sale of these securities go. So we have a use of a central bank's balance sheet as another instrument of monetary policy because interest rates can't do the job. Bank of Japan is in the same situation. It is now going to buy corporate debt in the open market. The Bank of England is doing the same, using its balance sheet, quantitative easing, headed toward near zero interest rate. At the moment, the European Central Bank does not appear willing or perhaps able to do this, given 16 countries in the Eurozone. It's a problem. Coordination is a problem. And other central banks not yet doing this, certainly not yet in the Republic of Korea. 3% can go down to 1%. That wouldn't surprise me at all. And then we'll see whether the Bank of Korea does quantitative easing as well. This is an experiment. This is the doctor running out of medicine in the medicine bag, dealing with an illness that hasn't been seen before. It's called experimental medicine. Might work, might not work. Might not work. Odds are it will work in one form or another. The sun always rises. Sometimes, depending on the part of the world you're in, you get 22 hours of darkness. That's Reykjavik. You don't want to go to Reykjavik. They won't like me when I say that. On the fiscal side, we have two actions. One is through the Treasury attempting to deal with the financial crisis and in turn helping the economy. That's essentially the TARP program. The TARP program was devised in a hurry-up fashion by Treasury Secretary Paulson. They threatened the House Democratic leadership in Congress with, if lack of action, the world would collapse, It's essentially what Chairman Bernanke and Paulson told the House Democratic leadership one Thursday night. And people like me who were advising the House Democratic leadership did say, you better hurry up and get something done. You maybe have a week to go before the market gets even worse than it is now. I now regret having said that as policy. I should have told them, take your time, hold hearings, don't rush into it. Instead, though, and this is what happens in the heat of the moment in policymaking, and why I'll always tell our clients, you can almost always bet on the government getting it wrong. You will make more money in times of stress making that bet than you will betting that they get it right. And I have seen this firsthand now in a number of policymaking situations. Well, we told the House Democratic Congress, make sure, I told them, don't give them all $700 billion right away. And I think I said things like, I wouldn't lend my neighbor $70 who was in trouble without asking for oversight of what he was going to do, he or she was going to do with the money. Treasury Secretary Paulson asked for no oversight. He wanted maximum leeway to do anything he and the next administration wanted to do with the money. It's taxpayer money. You can't do that. Other people argued the taxpayers should have a stake. So they fumbled their way and finally got a program passed, although the Speaker Pelosi fumbled herself on one day, which she contributed and didn't count votes, so it didn't get through the House on the first go-around, and the markets went kind of nutty. But they got it through, and then what happened? This misdirected, strange program that came out of the bowels of the Treasury Secretary and his Goldman Sachs advisors, tried to set up markets for securities for which there were no markets, complex hundreds and thousands of securities called derivatives, sitting on the books of numerous financial institutions where the asset value of collateral, housing prices, kept going down. Somehow they thought they could have a market for that, and they would do an auction market. That didn't make any sense. The problem is housing and housing prices. They did nothing for housing and housing prices in the Paulson plan. And so we got what I think we should have expected. Housing prices kept going down, the asset value of collateral kept eroding, the balance sheet values of the financial institutions that had this toxic stuff on them kept going down. The credit rating agency said, we're going to lower your credit rating. The short sellers sold, they had a field day, and financial institutions kept getting deeper and deeper into trouble. Then along came Gordon Brown, who used some of the money to recapitalize the banks in the UK. The UK is a little easier with nationalizing banks than the United States is. This was a move in that direction. And so Treasury Secretary Paulson, frustrated by the inability to get buying the bad assets off the balance sheets, went to feeding funds into the banks, financial institutions that they thought would survive. That capital went in, and guess what? Is it any surprise that none of the financial institutions with those funds did not lend the money? Why would they, in the environment I'm describing? Why would a risk-averse financial person put any money out to individuals or companies when they were already in trouble? Should be no surprise. And where we are on the TARP program now is the second tranche, $350 billion, after we have almost exhausted the first tranche. $350 billion will be used more for housing, which is good, more to mitigate the foreclosure problems, and also used probably to, in some form or fashion, perhaps purchase bad assets off the balance sheets of financial institutions. But here's the rub. Americans are furious about this. Congress is feeling it, and it's not clear that they will actually be able to do this. Why are Americans enraged? All the monies from this program appear to Americans to be going to the banks and the financial institutions. And who do Americans think caused the problem? Wall Street and the financial institutions. So the congressmen and senators have never heard the wave of outcry and protest and enragement that they are hearing from Americans now. It's my money. It goes to these institutions. They buy a plane. They buy another company. I'm losing my house and losing my job, and you're not giving me any money. The political clash around this is intense. And we'll see how it plays out. Finally, the economic recovery plan, fiscal stimulus. Not unlike a lot of plans in countries around the world. Countries around the world are responding to the current situation in terms of increased government spending. Some countries are in better shape to do that than others. The U.S. is not. Our budget exposure, our financial exposure is immense. South Korea is in better shape to do it. Japan is not. China is in better shape to do it. We don't know what their budget really is like, but we know the foreign exchange reserves are somewhere around $2 trillion. South Korea has ample foreign exchange reserves. Plenty of financial room to stimulate. U.S., right now it will be an $800 to $900 billion plan. It looks like right now about 65% government spending. That's purchases. That is for infrastructure, roads, highways, in a more modern cast of technology orientation. A lot of money in the states and localities to help states and localities handle Medicaid. That's a healthcare issue. And to do their projects on state highways and in localities, and some on schools. Some for unemployment benefits and healthcare support for Americans who are out of work. And about 35% tax relief, 2-year program for middle and lower income families geared to Social Security payments, a temporary 2-year sense, tax cuts of $150 billion and a few other tax cuts to go along with it. Both branches of the program are designed to sunset 2 years down the road. And on the outlay side, the plan is that it will go back to the baseline. Our model studies on this plan, allowing for the lags of implementation as codified by the Congressional Budget Office, suggest 1.5 percentage points of extra real GDP growth in the first year after implementation. That would make our forecast of -2% for the year more like flat to down 0.5% in real GDP. In the second year, 1.25 to 1.5 percentage points higher growth than otherwise. If nothing else happened, that would make our forecast for 2010, instead of 1.5 to 2%, 2.5 to 3%. Recovery, I think for sure, sometime in 2010. But what kind of recovery is that? Well, at the moment, the plan is almost 2/3 government spending, a little bit less. And it is 1/3 tax cuts. It's safe to say that the motion of the United States in terms of fiscal policy and its new administration is toward more involvement and a stronger role for the federal government, and the use of the federal government to establish goals that are perceived by the Democrats as having been assigned to them from an overwhelming election and rejection of the Bush administration and the Bush priorities and years. And they are indeed moving very quickly in that way. Plenty of money will be spent for construction. Plenty of money will be spent for government, federal, state, and local kinds of projects. Some money will be given to households. We know, we think, our studies show that we'll have a big increase in government employment. Our question is, what will happen to the private U.S. sector? Because this recovery will be different from almost every other recovery in the last 35 years. It'll be motored by government. Usually it's housing first because of lower interest rates, consumption second. Consumer's very springy, goes down but comes up sharply. Business follows. Government tax cuts or spending only have been used in the last couple of downturns. For quite a while it was only monetary policy, but monetary policy can't do the trick now. And so we're not going to get the usual pattern, at least in our view, even if they tweak this program a little more toward tax cuts and away from government spending, which is the motion at the moment in Congress. Quite unpredictable. We're not through yet, and so I can't be precise because I don't have the full program. But that's a big deal, because the private sector of the U.S. economy may come on eventually and be vibrant, but it's not going to lead the charge out of this downturn. You need to think about that as business people, decision makers, and observers of the situation. It's different. And in fact, in lots of countries around the world, this is the major way that policy is going. And maybe there's no other choice. If private sector demand fails and is inadequate, government spending will pick up the slack. And we'll add to real GDP. But real GDP for people who make business and financial decisions can be the lousiest, the worst indicator of any to follow with regard to business decisions. Be careful. You can have a recovery in real GDP, and your business, if it is involved with the American consumer, can do very, very poorly. The jury is out in the United States. We don't think that will happen. We think basically for the world, given all the stimulus that's coming in, we'll go through a period of time of some deflation and then we'll reflate. The alternatives are a 1930s Great Depression analog, 15% odds. I can't say, I think the odds are tiny that the U.S. and world won't have a Great Depression-like situation. The other side of it is everyone is cutting back in a hurry. It's a herd instinct. All the adjustments are going to be made very fast. The amount of fiscal stimulus, number of countries doing fiscal stimulus, adds up to rather sizable sums of funds. And that will lift the world economy. All of the force feeding of finance into the U.S. and other economies that central banks are doing will save the financial system, and they will start to lend sooner. A V-like result. Here's the issue on the alternatives. It's like Jekyll and Hyde. Do you know the Robert Louis Stevenson book, The Strange Case of Dr. Jekyll and Mr. Hyde? It's like night and day. If it's a 1930s-like situation, as an alternative to what I've described, which is, this is a transition year, we have some sort of recovery next year. It's led by the government, not by the private sector. That has a lot of implications. If it's a 1930s-like situation, how do you run your business? How do you make your decisions? How do you run policy? If it's a V, force feeding, then you should be on the inflation trade that will have a big reinflation. Tough world, tough to forecast, tough to analyze, even harder to make policy in any country in the world, particularly at this time the United States.